Alright folks, welcome back. This is volume 3 of the Inner Circle Trader Market Maker series. In this volume I'll be teaching on market structure, key levels, and SMT. Alright, we're going to assume that when you're doing your qualitative analysis, that means we've already gone through all of the quantitative. We're assuming that the market price is up here, and your analysis suggests that there is a move likely to ensue that takes us down to a key level low. Now these key level lows can be weekly lows, old highs of a higher time frame like 4-hour daily or monthly or weekly. They could be the top of an old trading range. There's multiple ideas that could be used for a key level, but what makes it a key level is it's on a monthly, weekly, daily, or 4-hour. Less importance and significance placed on the 4-hour, predominantly the higher time frame daily, weekly, and monthly. Now these levels are important. What makes them key is because they're used by large fund traders in their analysis. They're not really going into these 15-minute time frames, 1-hour charts, and things like that. Their analysis is predominantly linked and founded on the monthly, weekly, and daily time frames because the volume that they work in and out of the marketplace requires them to be trading on those time frames because they don't have the luxury like you and I to get in and trade on 1-minute charts, 5-minute charts, 15-minute intraday. So the idea is we're expecting where the market is now to trade down to this level, and then a reaction should ensue. Now your choice as a trader is, if we're here and you think it's going down here, to set up a move to go later higher. You can be a trader from this point here down, or wait till it gets to this level and then try to trade the bounce. I'm going to leave that to you to decide, because a mentor should not try to press everyone into a mold. It isn't a one mold fits all. It's a approach to understanding how price is delivered, and then you as a trader find a strategy or a process that allows you to engage price action without you feeling like you have to meet the same expectations that someone else is doing. So as the market trades down, inside this price swing, there's multiple opportunities in the form of swing trading, short-term trading, day trading, scalping. And you can trade on both sides of the marketplace. But predominantly, the larger position and or more risk can be assumed on the short side. Whereas going long, maybe scalping, something like that, you got counter trend to this expectation in the marketplace, you'll use a lot less leverage and try to be much more nimble. In other words, your objectives will be much more smaller than that of if you were trying to trade in line with this movement here. Once it trades to this level here, you would expect higher prices, and you can trade obviously with the majority of your leverage on the long side, and any scalping or short-term trades against this idea should be done so with very low leverage and very short-term price objectives. Now let this image burn in, so that way when we transition to the market maker buy model, it's this idea we have in mind here. Okay, market price is here, we're expecting it to trade down to a key level and then rally up. Now these lows can form two different ways. You can start by coming down, come off that short-term low, and then make a lower low, creating the ultimate low in this price swing here, and then price running higher. This sets up a ICT breaker where we have a low, high, lower low. Once it breaks that short-term high in the middle, if it trades back down into that, we could be a buyer somewhere over here to capture another continuation on the upside. Conversely, there is another formation you can see where it trades down, comes off the low, and turns with a higher low and starts to trade higher. This one here, I like to see this form only if there is a SMT divergence that would be in a market that's closely correlated to the one I'm looking at here for the analysis. And what do I mean by that? Well, let's assume that this is the euro dollar, and I expect the euro dollar to trade from its market price down to a key low and then trade higher. At this low, if I see euro making the low and then a higher low, at the same time, pound dollar is making a low and then a lower low, that's an SMT divergence. Okay, smart money technique or smart money tool. I never really settled on the letter T, what it would stand for. It was always interchangeably used as smart money technique or smart money tool. It's just simply a divergence between closely correlated assets or markets. What this indicates is there's a strong disparity between what the algorithm is pricing in for one currency versus another. The theory I operate under is all boats rise with the tide. And if we're expecting higher prices in euro, it goes without saying that we should reasonably expect pound dollar to rally as well, unless there's other factors that are outside the scope of this teaching that would negate that. But for the majority of the time, and a general rule of thumb, all foreign currencies should be rallying together and falling dollar seen with that instance. Here, if we have a higher low in euro and cable goes low, lower low, it's indicating that the algorithm is not wanting to take euro dollar to a lower low like it did with cable or British pound versus US dollar. And that crack in correlation many times signifies a timing aspect that would be confirmation to expecting this level down here being significant or key that leads to an upward price swing later. Okay, with that idea in mind, usually the market will be in some measure of consolidation. I like to see some kind of a little short-term trading range, and it is very subjective, this part. Okay, what is a trading range or a consolidation? Where a price is having several candles, not 2, not 3, not 4, but it just stays in an area over a prolonged period of time. How much time, Michael? It's all relative to the time frame you're looking at. If you're looking at a 15-minute time frame, it could be, I don't know, maybe 10 candles or more. And I'm just giving you a rough idea because experience is going to guide you on how many candles really make up a consolidation. Studying price, especially if you're a new student, this is going to seem too vague. And I had this complaint before when I was teaching on baby pips. As soon as I started to introduce an idea, right away they expect to have the understanding entirely from one lesson. And you have to have something of a comprehensive study approach to what I'm teaching because it's not simple, but it is simple once you understand all the moving parts. So from a modular standpoint, when I say that the market is usually in some kind of a short-term consolidation, it could be, consolidation on one time frame, but just simply 2 or 3 candles on another time frame that would be higher up. So it's all relative to what you're expecting in terms of the market price. If it's on a 5-minute chart, the consolidation may look a lot longer in terms of duration, versus if you look at it from a 4-hour chart, it's all within one candle and you don't even see a consolidation. But for the sake of continuity, let's just assume that we understand there's a short-term consolidation here. I'll be giving you an example here so that way you're not left with too much vagueness. So the market will leave this consolidation, and inside this decline, we wait for another area of either retracement back to the original consolidation, which it does not have to do. Okay, it does not need to do this. This is kind of like what the Wyckoff theory folks will look for. There's lots of times where it just doesn't do that. And that's why I don't teach Wyckoff. That's why what I'm teaching you here is not Wyckoff. So as the market drops down, I allow in my analysis the potential to return back to the original consolidation. But if it does, I need to see a very sharp rejection there. It can't just come back to the original consolidation low and then hang around for a little while. It needs to come back up there and then break. I like it even better if it tries to make an attempt to get back to the original consolidation low, okay, and fail to get there and then breaks hard. I really like that because that indicates a very heavy market and it's likely to continue going lower. But either or, the next short-term consolidation, and this doesn't usually last as long as the original consolidation up here. So what we're looking at is a consolidation, a market that breaks lower, that maybe trades up to here. And if it does, we'll look for a sharp decline. If it doesn't and just goes right into another area of consolidation, it usually will set up like an optimal trade entry. And if you're new to this channel or you're just watching this video for the first time, I have a plethora of videos that teaches my optimal trade entry pattern. It's a very simple little pattern. It repeats every single day. It repeats on every single time frame. You just need to know what you're looking for and why it should be forming there. And this is really the point of this lesson, is where in market structure should things occur and how do we interpret it and how do we anticipate it. So in this area here, usually you're going to see an optimal trade entry short. It'll be a low retracement back up into a bearish order block and then slams lower. Or it could be a low short-term high and then a higher short-term high that runs out short-term buy stops. Then it sells off. So either one of those instances will allow for me to take a trade going short. Because remember, I'm waiting for some level down here I've indicated at the beginning of this discussion that I think it's going to trade down to. Or I'm watching price and I'm not really engaging price. I'm just monitoring it and practicing and reading price. And I anticipate some measure of selling in this area. Or I'm watching price so that way it just keeps me closer to the marketplace. And I'm practicing either with a paper trade or a demo trade, or I'm illustrating something with my teachings and lessons. I'm just anticipating, whether I'm engaging or not, another price leg lower. And when it comes, should it come, we're waiting for some kind of expansion lower. And sometimes we'll get a secondary level of distribution, which will be another either optimal trade entry sell or a short-term high that's ran out with a higher short-term high and then leads to another level of lower prices until we get into that area where we expect that key level to be reached. This is where the market goes into smart money reversal. Okay, usually it will form the same way it is outlined in the price swing, where it'll create a low, a lower low, and then look for a breaker, or it goes low, higher low. And if it occurs like that, again, using the intermarket relationships I mentioned earlier, if it creates a low with a higher low versus one definitive low that takes out a previous short-term low, in other words, the diagram I outlined when it was just that big blue V giving you a rough depiction of a price swing, the little animations I put in at the low, those are the only two things that can happen. That's it. So how they trade and form in price leads to what process you look for next. I'm not really interested in a market that will give me a dull, flat, blunt-ended low. I will avoid that. At all costs, I'll avoid that. Because that means I'm going to have to wait, because we could be seeing just another level of distribution that leads to another break lower. And then I'll revisit the analysis at a later time. But if we see price trade higher, we're going to assume that the smart money has accumulated longs in here. They are not pushing price up when they go long, by the way. We're seeing price trade down to this level, and then it kind of like spends a little bit of time down here, not a lot, certainly nowhere near the length of time that the original consolidation looks like. Very short-term little consolidation. And the algorithm keeps price in that range. Okay, so it's a small little dealing range it works in, and then it'll reprice. If smart money traders do not buy, they miss that move. So they'll have to wait for a low-risk buy. And that usually will happen over here in a small little consolidation, which will form in what? In the form of a optimal trade entry buy, or a low, and then a short-term lower low that takes out buy stops and then rallies. Remember I taught in the previous lesson in this series that usually right before significant price advances higher, some little short-term lows taken out for stop raids, and they assume those positions when the stops are taken. Those sell stops flood the market with selling, so that way counterparties that understand what the algorithm is about to do with price sending it higher, they'll buy those sell stops, and they'll be positioned for a rally higher. We would expect price to trade higher until we get to another level of accumulation. So what we've already seen here is consolidating and accumulation of shorts. Accumulate more shorts. accumulate more shorts. In this area, you may only get one area of distribution, and then it trades down to the smart money reversal, where they distribute their shorts down here. So they're going to buy to sellers at a low price, and everything they assumed over here should be hopefully offloaded here. Some of it here and some of it here. So their heavy positions are entered here. Some of it's taken off in profit here. Some of it's taken off in profit here and here. Or they'll go short here, add more here, and dump it all off here. So there's two ways for them to engage price and work within this market maker buy model. The longs that they assume here, they may not get them all on, and they'll have to add more here and then add more here, because as price is rallying up, it's going to be targeting the original consolidation until it targets the buy stops above this relative equal high or consolidation. All those buy stops will be the target of all of this. So if you're looking at price and you think that it's going to trade lower to go higher, the original consolidation, aim there. You might have a higher time frame target somewhere beyond that, but initially study all of old price data, price swings, and you'll see this phenomena is occurring. And you don't have to have all of the complications that are introduced with retail concepts. I mean, this might seem too vague, and it may seem an oversimplistic approach to describing something, but I promise you, go into charts and study it, you'll see this very thing unfolding. It happens on all time frames, and it happens on buy and sell. This is a market maker buy model where they're taking price down, not the traders, the algorithm. All the algorithms are working together. It takes price down, then allows traders that know what to anticipate to onboard here. And then they take it in scalings here and here. And then finally, the last bit of a run, it's in a hurry to get above here. And this is a complete market maker buy model. This is unique to me. This is something that I introduced years and years ago. And there's been some subtleties, people adding Wyckoff to it, trying to make it look like it's Wyckoff. It's not Wyckoff. It's very specific things. And elements that are over here have to agree with over here, and vice versa. And again, that's outside the scope of this teaching, but just know that there's logic that is very precise. It's extremely precision oriented, but this general idea here will serve you well as a roadmap for studying price swings. Now, conversely, we can look at price doing the opposite, where this is a ICT market maker sell model. We're going to assume that the market price is down here, and we think that the price is going to go up to some key high. Again, that could be running on an old high. It could be trading to an old high and just falling short of it because we don't think it's going to go higher. It could be trading back into an optimal trade entry sell. There's all kinds of things that would be outlining this as a key level. But what makes it key, again, is it's a monthly, weekly, or daily level, and at the lowest, 4 hour. But again, I'm only throwing the 4 hour out there as just an extra side note, because predominantly the levels are going to be key because they're on those top higher time frame, daily, weekly, and monthly. So as the market trades higher and runs into that, you could be a participant in buying that up or studying it as it rallies up into that key level, and then the expectation of lower prices if it materializes. This whole fractal, or price swing, is what we're trying to strip down to its basic components. What elements occur inside this entire price range? That's what we're highlighting here with the models. The high can form, obviously, with the higher high and then breaking down, which sets up a potential bearish ICT breaker, which would be over here somewhere. But the high and then higher high forming this high, this is what I like to see. I'm more confident with this pattern. But conversely, if we're looking at it where we have a high and a failed higher high, and then it breaks here, this is only significant in a market structure break if we have intermarket relationship confirmation. Again, let's assume for a moment that this is British pound versus US dollar. And British pound versus US dollar makes a high and a short-term lower high and then breaks down. This is ideally a break in market structure on cable or pound dollar if euro dollar makes a high, low, higher high, and then it breaks down, because that would be a correlated pair SMT divergence, smart money technique or smart money tool. Because what that is indicating is that cable was underlyingly weak from an algorithmic standpoint. It was unable to make a higher high where euro was. And I'm speaking hypothetically, obviously, but that's how I would use this lower high formation. So in other words, if I think it's likely to form a lower high, then my attention will go to a correlated market. Like, again, if this is assuming pound dollar, I'm going to be really watching euro dollar, and I want to see, and if it's occurring here in cable, I want to see and almost demand that it's a higher high in euro. Now, if it creates a higher high in cable and it creates a higher high in euro, that means we might not be really topping yet, and I'll have to wait for more information or a real strong breakdown, and then I can get back in sync and trade with it later on, as you'll see. All right, again, the assumption is that we're at a market price down here. It could be trading in relatively cool lows or consolidation. Then it leaves the consolidation. At this point, again, the same, it could come back to the original consolidation high, but it doesn't have to. We're waiting for it to rally up into another area where it creates an optimal trade entry long, or it creates a short-term low and then another short-term low that's lower than it that takes out sell stops. And then we anticipate higher prices rallying higher until we get to another level of accumulation. So each one of these levels over here is accumulation. And another point of advancement on the outside until we get to our key level where we anticipate smart money reversal. Okay, so smart money reversal occurs with some measure of consolidation, not a lot, okay, but we're anticipating, expecting the algorithm to kind of like hold up here for a little while. What's a little while, Michael? Again, it's all relative to the time frame you're studying, because if this is a 5-minute chart, it's not going to spend 20 candles in a 5-minute interval up in this area. You know what I'm saying? Like it's going to be very short-lived. Whereas if we were on a 4-hour chart and we're seeing this pattern, and we're looking at a 5-minute chart, then it's going to probably look like a whole lot of candles. So it's all relative to what you're looking at through what time frame. And again, the way you learn how to do this and get better at reading what I'm suggesting here is you look at old data, the back testing and studying of old data. Every successful trader, every single one, whether they come through my camp or on their own or wherever else they went through it, they're always going to be better and versed because of their own study, the time they spend looking at old data and studying those price swings, because those things repeat. That element from rallying here up to some key level and then expecting it to trade lower, it will have all these elements to it. They might look slightly different each time, but they generally have the same repeating themes. After there's a smart money reversal, we expect price to trade and break lower until we get to another level over here, where we would see another optimal trade entry sell. So it'd be a low, a retracement back in, maybe to a bearish order block, and then a displacement lower until we get to another level of distribution. Now, in here, it could be the optimal trade entry sell, or it could be a short-term high and a higher short-term high, and then breakdown. Same thing here. It could be an optimal trade entry sell, or a little retracement where it creates a short-term high, starts to go lower and runs up one more time, takes that out. And the question you're probably asking is, when does it do that? When will it do that in an optimal trade? Like, for instance, if you took a trade thinking it's an optimal trade entry sell here or here, how do you know that it's not going to be one of those trades where it takes out the short-term high that you went into going short and you get stopped out? That's going to happen. I can't promise that you're going to walk through this marketplace without having those cuts and scratches and bruises. You might break a bone or two. Okay, you're going to lose some money. But let's assume for a minute you're taking an optimal trade entry short here. And this goes for the same thing I just mentioned on the market maker buy model. This is the market maker sell model. just reverse everything I'm saying here for the other one. If you take an optimal trade entry, sell here, and it starts to go down and then runs up and takes you out of the trade, then what you can do is put a sell stop below the short-term low that's formed thus far. And if the market goes down there, it could take you right into the market short. And if it's going to do what we're expecting here, it probably isn't going to do a short-term high that's higher, and then a short-term high that's higher. That's unlikely. Can it happen? Yes. So rare, it's probably never going to happen, but it can. So there's no reason for you to fear being knocked out or kicked out of the marketplace and take a loss, because if your analysis is correct, then you're probably still going to capture some move and overcome that drawdown you've taken here. And if you get this other opportunity over here and you have a stop run here, chances are you're probably not going to get a stop run here. It'll probably just be the optimal trade entry run right from a bearish order block down. And it usually will be aggressive and quick to get down to the low of the original consolidation where sell stops are resting. So this is the elements to a market maker sell model. And again, for someone new, for someone that has not been looking at price charts for a long time, this is going to look too elementary, too simple, too vague, well, it's not really showing me anything. I'm not really grasping it. But I promise, if you go through your old charts and look at a price swing, say on a 4-hour chart that does basically something like this, and then you study it from a 15 or 5-minute chart, and you'll see this general idea. All right, so let's go over to the British pound. And if you've been following along in recent weeks, the discussion on pound dollar I gave you guys is very serious too. But let's take it back a little bit. Let's assume that we're looking at this level over here. It's a daily chart. It's relative equal lows. So you know what's resting below that, sell stops. And we're trading right here. So we're looking at this high, the low, and we retraced in, and we look like we're about to break lower. We have relative equal lows in here, so there's sell stops there. Lots of sell stops there. So we would expect to see price trade down there. So this is a key level. Ultimately, price does cascade lower. All of this here, my students in mentorship, we knew about this. We outlined this, talked about it before it happened. And the market has now, at this point, traded sell stops, accumulated longs, and then we have these relative equal highs. Okay, in the last lesson in this series, I talked about how this is the next draw on liquidity, and the market trades up into that on Thursday of the week of this production, and today's Friday. So the market trades up, and we've completed a accumulation of sell stops and a distribution to buy stops. Smart money buys sell stops and sells to buy stops. Okay, so we can use all of this information here for the weekly range to get to our objective on weekly PIP objectives. Let's assume this is that area where we were looking for the buy stops, and this is where the old low was on the daily chart where the sell stops were. Look what we have here. The market's consolidating. It leaves the consolidation, but why doesn't it come back up here? It doesn't need to. So it's better for it not to do that. And we have what? We have the level of distribution here, because we have what? Optimal trade entry, sells off. Another level here, optimal trade entry, sells off. Trades below that old relative equal low on the daily chart. That's that blue level on the daily chart. There's equal lows. Those sell stops are being absorbed here. The algorithm holds price in this little consolidation, allowing smart money to accumulate. Their buying does not send price up. That's not how this works, folks. I know you have books. I know you have authors and teachers and wannabe mentors that tell you that the buying sends price up like this. It does not. How many times have you seen people saying, oh yeah, we bought this, and I'm long, everybody's long. Everybody was long in Bitcoin before 20,000 back in several years ago. And I called the top on that. But everybody was buying, but it just still didn't send price higher. It went the other way because these markets are manipulated. They're controlled, folks. I know it doesn't feel good to hear that. It doesn't feel warm and fuzzy because it feels like, man, I really don't have a chance. No, in fact, you really do have a chance. If you understand how these markets are manipulated, you follow suit with what the algorithm will do. You're not going to always know. I don't always know. I know a lot. I know lots of times when it's going to do specific things. And I know when it's not likely to do the things that I would normally expect, and I avoid trading. But in this instance here, the market's consolidating, allowing smart money to accumulate longs. Once it takes off here, they can't enter. They've already missed that opportunity. So they're going to have to wait for some new level of accumulation. We have a low, a high, optimal trade entry in here, rallies up. We have another level here. From this low to this low, that's optimal trade entry because you have a high, low, higher low. Boom. Rally. Trades up, consolidates, rallies again, and then drops down, takes out that short-term low. We talked about this in the previous discussion, or volume. And then it accumulates and goes higher. The algorithm is driving price up here. It's not the buyers. Okay, it's not the buyers. The question is this. If it was just the buying pressure, why didn't it run from here all the way up to breakout above here? Because that's where we were aiming for. Why didn't it run from here right above here in one shot? Why is it doing all this consolidation? I mean, think about it. If the buyers are really controlling price and then retail traders come in behind and they buy it later, chasing price, why doesn't all that translate into just singular price runs where it just goes in one shot? Because that's not how the markets book. Okay, it's not how it works, folks. All of these lows here are critical, as we'll talk about in later discussions that are outside this video. But nonetheless, we're looking at how price trades down into levels that take out short-term lows. Short-term lows were taken here, it rallies. Short-term low was here, it took it out, and then it rallies. Short-term low here, trades down below it, and then on FOMC right there, it wipes it out one more time and then rallies. Then it takes out this level here, which will be critical later in other videos in this series. And ultimately takes out all the buy stops above this relative equal high and or original consolidation. So this is a market maker buy model. This was what I hinged the analysis on in this video series live as we were walking through this week with you, and my mentorship students knew about this as well. The bias, why I was looking for what I was looking for, what I was expecting in cable, it's based on what I'm showing you here. Now, there's a lot more things that I'm teaching mentorship students that aren't going to be included in this series, obviously. And you can get upset and be mad, or you can say, you know what, I appreciate what you're showing me here. This is enough. You can make lots and lots of money with this. Okay, lots of it. You don't need a job. You can win FTMOs, and you can do all these funded account contests and get funded using what I'm teaching you on this YouTube channel. You do not need to buy mentorship. I'm not offering seats to it anymore. That area is closed down. But this is something you can study on your own and go into your charts and see what I'm showing you here repeats over and over and over again. And in 2022, after March, because I'm going to take a month off, I'm going to be more active on the YouTube channel, and I'll be teaching a lot of these types of things real time, so that way you'll be able to see over my shoulder what I think is going to happen, and I'm going to just use what you've been introduced in this YouTube channel, and you're going to see how quickly and easily you can hit the ground running and find consistency, and I'll be like a little bit of a guide through YouTube doing that. Now, we're going to talk about SMT, Smart Money Tool or Smart Money Technique. When we were down below these relative equal lows on British pound, we're expecting price to accumulate those sell stops. But how do we know that that's really going on? How can we trust that? Well, bring in the dollar. The Dixie, DXY, is being overlaid on the pound dollar chart. And on TradingView, you can see that the dollar index went a little bit higher than this short-term high there. At the same time, pound dollar was unable to go lower than its previous low. Now think, if the dollar is going higher, pound should be going lower. But if pound is going higher, dollar should be going lower, vice versa. But if you look for times when there should be a key level influencing price, this is when you go to SMT. Now, I taught SMT on baby pips like 10 years ago, and everybody took that and ran with it and tried to make SMT occur on all time frames. Every time they wanted to get a trade, they're looking for it. You only consider using SMT, which is a divergence between correlated or inversely correlated markets. If you're looking at the dollar index against the pound, or if you're looking at the dollar index versus the euro, or the dollar index versus the Australian, okay, that's a USDX SMT divergence, or dollar SMT. If you're looking at correlated pairs that are like euro and cable, or like, let's say it this way, euro dollar comparing its lows to pound dollar, that is a correlated pair SMT divergence if you see them break their correlation. In other words, this is a breaking correlation. This high with a higher high on dollar should have been seen with a low and a lower low on cable. But notice what's happening. This right here is how the algorithm tips off the traders that are in the know. We already know going below those relative equal lows that their sell stop center is probably going to go down there, accumulate, and go higher. That's likely. But how do we really know and trust that's going to happen? The dollar index gives us the insight, the x-ray view, if you will, where it went high, higher high, low, failed, lower low. So it's telling the traders without really broadcasting it that, okay, cable's going to start going higher because it failed to make that lower low where the dollar made a higher high. So this is SMT divergence. Higher high, higher low. This is occurring at the same time we're below those daily equal lows, and we're expecting price to go higher anyway, and all this does is confirm. SMT is not a timing tool, it's a confirmation tool. Okay, it confirms something that you were already expecting anyway. And this is why a lot of folks that learned from me on baby pips thought that, oh, SMT doesn't work. It doesn't work because I tried to look for it here and there, and it failed here, it failed there. You don't go into your charts looking for divergence between highs and lows. That's not what you're doing. You have to have logic and some measure of a narrative behind what it is that you're looking for. Otherwise, the divergence could be there momentarily and then completely evaporate. And then what did you trade on? You traded on the basis of like an indicator. And this is not an indicator when it's done correctly, because I'm comparing the price of one benchmark currency, the dollar, versus another currency pair, and they should be mirroring one another. Okay? So if this is higher high, this should be lower low. If it doesn't do that, that to me indicates as a crack in correlation. Therefore, it's tipping off algorithmically. This is the signal that it sends. It's not, oh, it went down and there was not enough sellers to send it lower. That's not what that is. It also isn't a low and there's too many buyers to let it go down. It's not that either. I'm telling you what it is. I'm telling you exactly what it is. And majority of you aren't going to agree with it because you know, you probably read 14 books, okay, or watched a couple videos on somebody else's YouTube channel, and they swear up and down that it's this and it's that, and they maybe have exotic cars that they're leasing, and they're trying to convince you with stacks of money they're carrying around with them all the time and going on trips. Go into a chart, okay, and use these things I'm teaching you, okay, and study like that. And you'll learn far more than any book out there is going to give you. Because most of the books that's being written now are just bleeding information from what I'm giving you here on this YouTube channel or from my mentorship. And that's the truth. And if it sounds arrogant, I'm sorry if it sounds arrogant. I'm not trying to be arrogant. I'm just telling you, if you're going to learn how to do this, you need to learn it from the source. And that's me. I'm going to show you how to use this stuff and make money with it. Real money, not demo dollars that I teach for compliance reasons, because I'm not licensed to give you trade advice. But I promise you this, if you learn this stuff and you get good with a demo account, what separates the ability for you to do the same thing in a demo account and a live account? Fear and greed. And I have modules in this YouTube channel to help you conquer that also. So there's no reason for you not to be making money. There's no reason for you not to be passing a funded account challenge so that way you can get out here and start making money, because times are going to start to get real tough soon, folks. Real tough. And if you're relying on your job, I'm telling you, you are setting yourself up for failure. I could be your best friend, and all you got to do is a pad and pen, sit down, take notes, and study. And experience will guide you. I'm going to put you in the right place in studying, but all that work is on you. You have to do all this stuff. You have to study it and go through example after example of hindsight data. And then you train yourself to see these things. You don't go in looking for divergence, because that's the same thing as a student that trades with retail logic will look at an RSI and say, okay, it's going higher and higher, but look at this RSI, it's diverging bearishly. And they try to go short, and they get their clock cleaned. It just keeps on going higher because they don't understand the underpinnings of the marketplace. Why should that market be turning there? There has to be some reason for that. If it's not underlyingly positioned to trade lower, it doesn't make a difference what indicator you slap on that chart. They're all going to flash bearish signals, okay? Because it's measuring mathematically a number of bars in the past. And by default, it's going to be going lower. And people don't understand that because they're not versed in basic math. Okay, there's simple things that you're being tricked by, but because they show example after example of it doing this or that in the past, then you go into it thinking, okay, well, I believe that this is going to happen because I've seen it in the book 4 or 5 times. Never seen the author trading with it, never seen the author doing it with a live account, never seen them show you in live market conditions. You don't see those things, but they have cherry-picked hindsight examples where they're talking about the left side of the chart all the time. I did this series again for YouTube, but I used real market action, real analysis to deliver it. How better can you expect from a mentor to be able to do it and outline it? I signed my name on it where I thought cable was going to go. And here it is. I did it on a week during FOMC. And I even traded FOMC. I put the trade on my Telegram. It's there. You can see it. And it went up and traded, and I did a one shot, one kill setup with that. All of that with this logic here. Better view of what I'm referring to here is SMT divergence. On the right hand side, it's the chart of the pound dollar, and the left hand side, it's the dollar index. Here's that higher high in its own chart, and then here's that higher low on its independent chart on cable. So these two price points are correlated to these two price points. This should have went to a lower low than this one. It didn't. But because it didn't do that, and we're below those relative equal lows on the daily chart on cable, this was accumulation of longs. The algorithm is signaling to interbank traders that this is going to go higher. Not because of buying and selling pressure deficiencies, but because it's being controlled and manipulated. Don't take my word for it. I don't want you to believe me. I don't want you to believe me at all about what I'm showing you here. I want you to go into the charts and study it with this premise in mind. Go into it looking to disprove what I'm saying, and you're going to shock yourself because it's there. It's been there all this time. And until I started talking about it, no one paid any attention to it. So until we talk next time, be safe.